Every payday, a slice of your money disappears before it ever reaches your bank account. You earn the full amount on paper, but what actually lands is smaller. And most Australians go their whole working lives without really understanding where that missing slice goes or why it goes there. So let's fix that today in the simplest way possible. Let's explain it the way you'd explain it to a curious kid who keeps asking why. Picture your income as a big cake that you bake through your work across the year. The government doesn't take a fixed slice of the whole cake. Instead, it cuts the cake into layers and each layer gets treated differently. The bottom layer of your cake is completely free. For the 2026 to 27 financial year, the first $18,200 you earn carries no tax at all. This is called the tax-free threshold. It exists so that people earning very little aren't taxed into hardship. If you earn less than that across a year, you pay zero income tax. That bottom layer stays yours whole and untouched. Now here's where most people trip up, so stay with this part. The moment you earn above $18,200, only the money sitting above that line gets taxed. Not your whole income, just the next layer up. From $18,201 to $45,000, that layer is taxed at 15 cents in the dollar. So picture someone earning $30,000 across the year. Their first $18,200 stays free, and only the roughly $11,800 above it gets taxed at that 15% rate. The tax always works its way up layer by layer. It never lands on the whole cake at once. Keep climbing, and the next layer runs from $45,001 up to $135,000, taxed at 30 cents in the dollar. This is the wide middle band where most working Australians actually live. Someone earning $90,000 still gets their bottom layer free. They still pay just 15% on the second layer, and they only pay 30% on the part that reaches into this middle band. Their full wage is never dragged up to the higher rate. So many people carry around a worry that earning a bit more will shove their entire income into a higher bracket and leave them worse off. That's simply not how any of this works. Above that sits the layer from $135,001 to $190,000, taxed at 37 cents in the dollar. And the very top layer, everything above $190,000, is taxed at 45 cents in the dollar. These upper rates only ever touch the money that genuinely climbs that high. Someone earning $200,000 still gets their first $18,200 completely free, exactly like everyone else. That's the heart of what a progressive system means. Everyone shares the same bottom rungs, and the rates only step up as your income does. So when a mate tells you they're in the 30% tax bracket, they don't hand over 30% of everything they earn. They pay that rate only on the slice of income that falls inside that band. The real percentage of your total income that ends up as tax is called your effective rate. It always sits lower than your top bracket. That gap is worth understanding because it changes how you think about every pay rise, every side income, and every extra shift you pick up. Let's make this real with an everyday example. Take someone earning $80,000 in the 2026 to 27 year. Their first $18,200 is free, so nothing is owed on that layer. The next slice, from $18,201 up to $45,000, is about $26,800 taxed at 15%, which comes to roughly $4,020. Then the last slice, from $45,001 up to their $80,000, is about $35,000 taxed at 30%, which lands around $10,500. Add those together, and the income tax sits near $14,520. On an $80,000 wage, that works out to an effective rate close to 18%, even though this person sits in the 30% bracket. That's the whole point in one clear picture. Your headline bracket and your real tax bill are two very different numbers, and knowing the difference keeps you calm every time your income grows. Now, the income tax layers aren't the whole story. On top of them, most Australians pay a Medicare levy of 2% of their taxable income. This is the money that helps fund the public health system. It pays for the hospitals and services you can walk into without a bill following you home. Low earners pay a reduced levy or none at all, but for the average worker, that 2% rides along beside the income tax layers you just met. Then there's the money going into your future without you lifting a finger. Your employer has to pay superannuation on top of your wage, and for the 2026 to 27 year, that rate is 12% of your ordinary earnings. This isn't taken out of your pay, it sits on top and gets sent to your super fund, where it's locked away and invested for your retirement. Inside that fund, the money is generally taxed at just 15%. That's far below most people's working tax rate, which is exactly why super is one of the most powerful wealth building tools an everyday Australian has. The system is practically handing you a lower tax rate to save for later, and far too many people never stop to notice. Tax also reaches you long after payday, every single time you spend. When you buy most goods and services, 10% of the price is GST, the goods and services tax. It's already baked into the sticker price, so you rarely feel it as a separate hit. But it's there on your coffee, your phone plan, your new shoes. Fresh food, most healthcare, and some essentials are left out, which softens the load on the basics of daily life. It means you're paying tax not just when you earn, but every time your money moves back out into the world. Here's the part that turns all of this from a lecture into something useful. Because the system taxes you in layers, you get real legal control over how much of your cake stays yours. Every dollar you claim as a genuine work-related deduction comes off your taxable income, and that shaves money off your highest, most expensive layer first. Every dollar you salary sacrifice into super is taxed at 15% inside the fund rather than at your marginal rate outside it. Understanding the layers is the first step. Using them on purpose is where financial freedom actually begins. This is also where tax refunds come from, and understanding them clears up another big source of confusion. All year long, your employer guesses how much tax to hold back from each payslip and sends it to the ATO for you. That guess is rarely perfect. When your deductions bring your taxable income down, or when too much was held back across the year, the ATO gives the difference back after you lodge your return. A refund isn't a gift or a bonus from the government. It's your own money coming home, because you overpaid during the year. And that's exactly why keeping records of your work expenses matters so much. Those records are what unlock the money that was yours the whole time. And one more thing worth holding on to. The 15% rate on that second layer is set to drop again, down to 14% from the 1st of July 2027. It's a small shift on paper, but it's proof the system moves, and the people who pay attention are always the first to adjust and benefit. So the next time your payslip shows that gap between what you earned and what arrived, you won't feel confused or cheated. You'll see the layers. You'll know exactly which slice went where, and better still, you'll know which levers are yours to pull. That knowledge is the difference between working for your money, your whole life, and finally making your money work for you. If this made the tax system feel a little less heavy, do me a favor and hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. I'll see you there.